Yeah, let me start the discussion on another topic, cost of capital. As you would have remembered, we last time we talked about, in addition to the introduction of the topic, I talked about what is capital. I'll give you again one idea so that you can easily recall what we discussed in the previous discussion. I ended my discussion in the previous video on this. This is the capital. So I told to you that this portion I would like to treat as you are finding in the slide. This portion I said that we would like to be treated as capital. If I give you idea, if I just give you any balance sheet and I ask you what are the compositions, what are the items which are involved in the capital, then broadly what happened here, you will find usually you will find owner's equity and or you will find long-term liability, or you could say loans. And what happened? All the short-term liability items are gathered here. So in a way, we can say, if I have to just tell what is this, what is capital, I'll say all the liabilities, all the liabilities present in the balance sheet on the liability side minus current liability, whatever comes, that is what capital is. So I come back to my discussion of cost of capital. So I'm again recalling this, that whenever we have to talk about cost of capital, this is the capital which we are referring to, and we are talking about cost of this part. Let me come back to the discussion on cost of capital. Uh, yeah. So when we say cost of capital, then we are referring to capital. So I'm again showing you this slide so that you have an idea that when we say cost of capital, we are talking about a particular type of thing. We are referring to capital. What happened? We should think capital like any other commodity. What happened? When we go to the vegetable market, we buy a vegetable. When we go to the clothes market, we buy clothes. We go to buy mobiles, we buy mobile. So what is happening in all the cases, whether we are referring to vegetable, clothes, or mobile, we are going to that place where these things are available and we are going to pay the price of that. But if I use the same analogy and I say that when somebody needs money to run the show, to run the company, he needs capital. But what is the price which is being paid by the company? That price, if I say, that price is nothing but can be defined as uh, capital or cost of capital. So this analogy is very fit analogy. Like, this cost of capital is in a way nothing but price to be paid, price to be paid to get the capital or use. So this is an important thing to understand. So like any other commodity, capital should also be treated like a commodity. The only difference between price of vegetable and price of capital, that price of a vegetable is paid in terms of absolute money, absolute value. Flat. Let's say you are saying that you are going to buy potatoes, let's say this is 40 rupees per kg. So this is the flat price given. But that's not going to happen in case of capital. In case of capital, what happens? Something is fixed in terms of percentage. We can call it interest. So interest I'm just using because there are some occasions where it would not be technically um, interest, but it's not completely wrong also to use the interest. If you take the input from the economics, you will find that when capital is taken, then some sort of rent is given, and that rent part is defined with the help of interest. So in that way, it is appropriate to use the term interest. Now we move to the idea of how to estimate it, because so far whatever we have done, we have not, you know, talked in terms of estimation. So estimation is something which we are interested. How to estimate this cost of capital. So when we say we have to estimate cost of capital, we have to understand slightly in more detail what are the components of capital. If I say what are the components, then broadly speaking, there are two broad components are there. Moreover, I can say when there is some capital, so capital is usually, this capital is usually comprised of two types. There are two broad varieties. One type of capital which is procured from the owners are known as owned capital, owned, and the other part which is taken in the form of borrowings can be termed as borrowed. I can call it borrowed capital and I can call this owned capital. So shareholders are the owners and their price can be termed as, if I use a technical term, I can call it cost of equity. Let me define these things. Similarly, this is also known as cost of debt. Let me explain to you when I say cost of equity or KE, what I am referring to. So I'm going to give you some conceptual definition of these things. Cost of equity, or for that matter, just cost of capital. So let me have this idea when I say, and I'll get back to that. Let me talk about cost of capital again. Cost of capital. So when I say cost of capital, I can define cost of capital as the minimum acceptable rate of return expected by the fund providers can be termed as cost of capital. I repeat the definition. I'll say the minimum acceptable rate of return which is expected by the investors or fund providers can be termed as cost of capital. Look at this definition. Minimum acceptable rate of return which is expected, this definition which I am referring to. So this is one of the best approach to understand what is cost of capital. Mathematics always comes late. Before we need to understand what exactly cost of capital is. So cost of capital is a rate of return expected by the set of people, those who are giving it. Just because there is not a single person, there is not a single group. There are many people that too they belong to different groups. So what we are just trying to generalize the definition of cost of capital. We'll say minimum acceptable. something, the rate which is acceptable to all, and we are just saying all the investors. Minimum acceptable rate of return expected by investors is known as cost of capital. So I'm coming back to this cost of capital. So this is the definition of cost of capital. And if I want to mathematically now, as I said that it has got two components, cost of equity, cost of debt, or practically capital is having two components. Some part of the capital, some part of the capital is made up of, if I say that this is the total capital, then some part of it, I'm just taking some example, let's say uh, mm, uh, 80%, and this is 20%. So, yes, I'm giving you an example. This is owned capital, and this part is borrowed capital. So, roughly, I'm just giving you the percentage. The owned capital can also be termed as, I'm giving you one more term. I can call it owned capital as equity, and this I can call it debt. So, I may use these terms also, debt. So let me take the example which I was just talking, cost of equity and cost of debt. So I'm saying the cost of equity can be termed as, I'm giving a different term to it. Uh, the way I would have defined, I can call it KE. I can define it KE. And similarly, I can define it KD. Now I'm giving you one definition, mathematical definition. I'll say cost of capital. This is also known as WACC. I'll elaborate this acronym. Just wait, be with me. Cost of capital is defined as weight of equity into cost of equity plus weight of debt into cost of debt. And just because it is talking about the respective weights, that's why this nomenclature of weighted average cost of capital, in a way, it is nothing but a weighted average. So we have just defined what is a cost of capital mathematically. So let's say for argument's sake, if I just give you some figures, like I'll say that let's say cost of equity is 12%, and cost of debt, let's say call it 8%. The cost means, it means if cost of debt is 8%, it means if a company would have borrowed 100 rupees from the debt providers, then at the end of the 1 year 108 rupees are supposed to be returned. That is the concept of uh, cost of debt. And if I use the same proportion which I have just defined to you, 80% and 20%, I take you to the Excel. And let's say, as I'm saying that KE and WE. So WE is uh, 80%. So I'm showing it by zero point 0.8. 80% is zero point 0.8. And cost of equity, I have just said it's 12%, so 0.12. And similarly, I have got KD. Just let me increase the size so that you can easily read it. So here it is cost of debt. Cost of debt I'm defining as 8%, 0.08. It's a normal procedure to convert all the percentages into decimals. When you do it, the probability that you will be committing less error is there. If you don't convert, then it is possible that you might commit mistakes. So this is 20%. I guess if I want to, I can convert that into uh, percentages also. Let me so it looks like that also. I mean, both are possible. Let me use W ACC, cost of capital. And what I am doing, I am just multiplying the cost of equity with cost of a weight of equity plus cost of debt into, and that's it. So this is my cost of capital. If you look at this formula, I have just used this formula. I have just used, I'm sure, I guess I have formula here also. Yeah, yeah, I like that one. Coming back. So this is WACC. This concept still needs one correction, two correction if I, but to begin with, this is great to understand so far. I can, elaborate this concept by two more things. Uh, this formula still needs some modification. What happened when I talk about capital? Then capital may be comprised of not two, if you remember. I said it is comprised of only two, owned capital, borrowed capital. But practically in the real world, you'll find that there is a third component also which is present. And if I just try to elaborate on that part, then there are practically three components. One is obviously we have understood equity, other is debt, and third I call hybrid security. And the world of hybrid security is preference share, maybe some convertible debentures. So there are other securities which are neither equity nor debts. We call them hybrid security. So now we are going to modify our formula. We are going to modify our formula of WACC. We will call it WACC. WACC is equal to, let me use more space. Uh, yeah, use here. Yeah. So I'll say WACC can be defined as weight of equity into cost of equity plus weight of, let's say I'm saying preference share, I'm using one, cost of preference share, so I can again put a bracket here, yeah, plus, and I'll use weight of debt into cost of debt. One more improvement I would suggest we need to do. We need to multiply it by 1 minus 1 minus t. We call it post tax. And I'll give you a little brief about this right now. So this is the mathematical expression which we are supposed to use. Yeah. Why this? That is the only question which I should highlight. Why this? Why this post tax part? What happened? Debt is a tax deductible item. It means if a company is paying taxes, then company's taxable income goes down. Company is paying interest, I'm sorry. If company is paying interest, then company's taxable income goes down in that proportion. It means paying interest has got additional advantage of paying less tax. So that's why we multiplied by 1 minus t means post tax. Let's say 30% is the tax, then this cost will be only 70%, because 30% cost would have been saved by paying interest and saving taxes. So this is the complete formula, and I have tried to explain to you what is cost of capital. I hope the concept is clear to you. Thank you very much.